Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Also, I'll just let you have a look at the couple of disclaimers that you need to quickly read through. I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives could be long-term fundamentals or short-term themes that increase or decrease in importance over time. Let's now go to, well, our goals really of the webinar are really to break down all the market jargon and complexities that we all read about. So if you do have any questions, please do ask them along the way, and I'll try to answer those as we go, or at least by the end of the webinar. This week then we'll follow the usual format, so we'll just check out how markets are trading currently. We'll then go into looking at equities, of course, which have been on a steep run already, a big bounce back from those lows that we saw recently, only in a matter of weeks, up about 10% and nearly regaining all that was lost in the previous months. We'll check out Nvidia's results as well, which came out overnight, and touch upon those briefly before then looking at some of the technicals around the S&P 500 and the Nasdaq and the Dow. Then we'll kick into last week's main data points, which were US CPI, US inflation, that is, of course, which have driven markets since, and I've really seen a major repricing of Fed rate expectations. We'll look at how that is shaping up going forward as well. Have a couple of charts for you to look at before then, checking out the FOMC minutes from last night. Nothing too major there. No changes really to current thinking. Before then, looking as well at UK CPI data that came out last week and was important, as well as the wage growth numbers for setting the scene as well for the Bank of England going forward. We'll then finally get into the main data of this week going forward, which will be the PMI data out tomorrow in the Eurozone and the UK, as well as some PMI data actually on Friday, but remembering, of course, that it is Thanksgiving tomorrow, so liquidity and markets, well, US markets will be closed tomorrow, and then it's a long weekend, of course, for most traders in the US. Okay, firstly, let's go to we'll go to just check out how markets are currently. Of course, stocks ended up last week on a high note, really. A small pullback this week, but really the dollar weakened after comments from Federal Reserve officials strengthened bets really that the Fed has reached the end of its aggressive rate tightening cycle. Asian stocks, really, they followed suit following US equities, and in fact the Nikkei touched a 33-year high earlier this week. Closer to home then, the dollar, that's bid, has seen a small bid throughout the Asian session today after the DXY touched a fresh September low and is currently trading around the 200-day moving average. It's really the lingering effect of last week's Fed speak from Fed officials, and then the associated repricing, as I've said, of Fed rate cuts, which we'll go into more detail later for 2024, which has really pressured the dollar. There's now even, I think, around a 25% chance of a rate cut in March. But as I said, we'll get into that a bit in more detail shortly. Gold, that's traded, currently trading around $2,000, but yet to make that clean break above probably 2010, which is important for that, for more upside, and then some of those long-term highs. Really, investors gearing up for rate cuts next year, so just be interesting to see whether we can get above that 2000 psychological barrier and then beyond. As I've mentioned, crude oil, interesting really, and a sort of gauge at the moment for potential global demand overall. We've seen initial short covering on fresh OPEC plus production cut speculation, and that's kind of run out of steam slightly, and the Brent is trading around the 200-day moving average itself. We do have that OPEC plus meeting, I think, over this weekend, so something to watch out for after that speculation around those output cuts. As for equities, I'm just going to pull up a couple of charts here first of all, which should give us a decent picture. We have the S&P 500 here that you can see. Equities really yesterday anyway, the markets really pulled back modestly. S&P declining 0.2%, Nasdaq shedding 0.6%. Tech really the worst performing sector. Microsoft dropped just over 1% as OpenAI was in discussion with Sam Altman. A lot of toing and going there, possibly his reinstatement as CEO. So he's not actually going to Microsoft, although of course they have been investing in OpenAI to the tune of around $13 billion, I think. So yeah, something to watch out for there after Microsoft did hit that all-time high, I think, on news that Sam Altman was going over to Microsoft, but that has slightly changed course. Retailers, interesting, underperformed. They had a couple of third quarter earnings out lows. They slid over 3% after cutting forecasts, and Kohl's and Best Buy declined after missing estimates and really giving downbeat guidance as well. The key events, as I mentioned, and really huge build up around Nvidia's earnings, which came after the market closed yesterday. Of course, you know, this stock has really been the year's hottest stock in a way. Generative AI fueled this fever-like, mania-like sentiment, and not least because of its phenomenal revenue guidance to the market. In the previous two earnings releases, this time, as I said, after the market closed, Nvidia, they reported results. Well, they surpassed analyst forecasts for revenue and profits, but they did warn that advanced chips that are subject to the US licensing requirements to ship to China will decline significantly. And they were asked numerous times about this and about guidance going forward, and they didn't give too much, and generally Nvidia haven't given guidance beyond 1 or 2 quarters. So just something to note there, especially because some analysts think that some of the demand, certainly from Microsoft, from Tencent, that has been sort of front loaded. So potentially a few quarters out will be interesting for Nvidia. In the meantime, the stock sort of dropped just over 1%. I think it's just back below that now, and after hours trading closed at a record high on Monday actually. And the stock price, well, it's tripled over this year, making it one of the best performers on Wall Street and lifting its market cap up to well above $1.2 trillion. For the wider indices, then we can just see this is the S&P 500. If I just drop to the weekly, you can just see this, well, fall from those summer highs around 10.9%. I think we're now back up in the space of 4 weeks. You can see there 4 consecutive weeks of gains of around 10.5%. So nearly back to those summer highs. Key levels for the bulls, if we do get past this sort of late August high at 45.41, then we do have then that late July high at 46.07, before then 46.37, and then the high from January last year at 48.18. Momentum looks good. We're not overbought, so that's encouraging for the bulls. If you just see on the Nasdaq, we've just got above here now. If I just pull up on the daily, actually, we have got above that previous high from July at 15.932. We're just above it now, you can see, and just closed pretty much on it. 15.933 was a close. Interesting, that break did look positive after that sort of bullish consolidation. The break from Monday did look good, and it's whether we can hold that, and there it looks like strong support around these levels, around sort of 15,700 or so. That's in the Nasdaq. On the Dow, again, well, I've actually marked it out here, drop of 9.39%, and then we're up, well, we're up above that now, 8.2, probably up to, where are we, roughly 8.6% or so, so nearly made back that summer sell-off. You can see, just pulling the weekly, taking these off actually, you can see we've said about this long-term level 34,281, capped at the upside, acted as a support, and then we burst through that, 4 consecutive weeks of gains now. So for the Dow, upside target from that late July high would be 35,679. Before then, we're looking at above 36 and 36,952 is that January high from last year. Okay, that is the stocks that we look at for the time being. Just bear with me 1 second. I just want to pull up then, if we move over to US CPI data from last week. Of course, that undershot market expectations for both the headline and the core. You can see this graphic here just giving us the main numbers. The headline rate is actually flat month on month, 3.2% year on year versus consensus predictions of 0.1% and 3.3%, while the core, obviously that excludes volatile food and energy, 0.2% and 4% against expectations of 0.3% and 4.1%. So the biggest component, we don't want to get into too much detail, but is owner's equivalent rent, and that cooled to 0.4% from 0.6% previously, and many economists think there is a lot more to come from this. It's a big component of the CPI basket and has a lagged effect, so that should be hitting the CPI numbers in the next few months. Energy fell 2.5%. That was led by a 5% month-on-month drop in gasoline, while car prices, both new and used, fell, and airline fares fell as well. Big uncertainty ahead of the numbers had been around medical care costs and some changes to methodology and history, but it doesn't really appear to be as big a story as feared. Just touching on one measure that the Fed do look at, the FOMC look at the super core measures, so that's services excluding energy and housing costs. And labour market tightness really has had a big influence on that. That came in a pretty benign 0.2% month on month, and that is really a key gauge, as I've said, for policymakers, and that pulled down then the annual rate down to 3.75%. So really, you've got to think the Fed have got to be pretty happy with these numbers, and really then that has sparked this sell-off in the dollar and market expectations that policy rates have peaked. Just according to the CME Fed Watch tool, Fed Funds Futures, then they're pricing in, as I say, a 25% chance near enough of a 25 basis point cut in March. Quite incredible that, with around 90 to 100 basis points of cuts now. By the end of next year. So yes, a big move, a big change from obviously expecting even a 25 basis point hike this month, next month, sorry, or January, and that was priced at around 40% at one point. So yeah, that's now a near dead certainty that there's no more hikes, as according to Fed Funds Futures, and that has caused obviously this big rally in stocks as bond yields have come off. Interesting, the S&P actually after the CPI data ended up nearly 2% higher on the day. That was his biggest one-day rise since late April. And then, as I mentioned, those yields, bond yields, 10-year yields, prices move inversely, or yields move inversely to bond prices. They were at their lowest level since last September, having obviously hit that 16-year high, that 5% level in 10-year yields. Sharp correction down to 4.5%, which is a big move in fixed income and government bond yields. Just going forward then, we said we'd just check out what is due to happen with CPI going forward. Interestingly, there's a number of factors which should potentially see these numbers coming down. Student loan repayments, credit card and car loan borrowing costs, very low housing transaction numbers in an environment of essentially weak real household disposable incomes will continue to slow consumer spending activity. That's generally what most economists think, and then we should see downward pricing pressures, while slower economic growth should then restrict corporate pricing power more broadly in the economy. Interestingly, Chair Powell has, of course, recently acknowledged that given the fast pace of the tightening that we have seen, there may be meaningful tightening still in the pipeline, and this really will then only intensify those disinflationary pressures, those falling price pressures that are building in the economy, and that is potentially what we will see going forward. As for other data, kind of been mixed really. We had better retail sales last week, We also had better Empire Manufacturing, surprise to the top side, but then we did have, and the market focused on producer prices, and they came in lower than expected. As for the FOMC minutes, I said I'd touch upon those. They came out last night, pretty balanced, garnered kind of little market attention really, and a little bit stale after the sort of more subdued data we've seen since the meeting, since the meeting, sorry, last time, with obviously softer non-farm payrolls and the CPI data as well. Essentially, the minutes noted all participants agreed to proceed carefully. That's probably the key couple of words now that we're focusing on and the markets are focusing on. And really, they will be watching whether sufficient progress has been made in bringing inflation down. Officials then generally agreed to keep rates on hold for some time and noted that financial conditions had tightened significantly. Just got a chart here just showing you then this trends, actually just stepping back, of core inflation and headline inflation. Headline, the blue line, headline, yeah, the blue line now at 3.2 and the headline now down to 4. Okay, so there's just that chart there. If we just now move on to, well, this week actually, just in the US, before we get to moving on to UK CPI, just we do have Thanksgiving, of course. That will mean lighter volumes, as I say, and then we do get as well US PMI data. That's probably quite an important release, has gained more traction in markets, although obviously they'll be thin on Friday, just because the Fed is more data dependent. Early data has been mixed. The Philly Fed non-manufacturing business activity index rose modestly. That's contrasting weaker signals from jobless claims and consumer sentiment. So yes, that's basically the US in a nutshell. If I just show you, if we just have a look actually at DXY chart next, dollar index, of course, remembering that is heavily weighted to the euro, which is around 57% or so of this index. But anyway, you can see big breakdown after US CPI numbers. And then moving through some fib levels, we've got these fib levels, which are of the summer rally in the dollar. We broke through the 38.2 at 104.48 or so, oscillated around there, and then another breakdown on Friday. That was a weak close on the week, so really signaling more downside to come. We saw that on Monday, of course, but we just found a small bid now, possibly month-end buying. But as well, of course, some covering of positions potentially ahead of Thanksgiving as well. Black line there's the 200-day moving average. That's at 103.61, you can see, and then the next retracement level, not fib level strictly, but retracement level is the halfway point at 103.46. So we're just oscillating around this sort of zone of support. If we do, well, we looked as though we were going lower. 103.17 is this week's low, and then sort of 102.54 potentially is the next fib level below that. Okay, as for other data quickly, we mentioned UK CPI data, and just grabbing a graphic of that, of the main numbers again, which you can see here. No great surprises again. UK inflation plunged in October, really. Impact of lower gas prices finally showed through in a meaningful way. Last year's 25% increase in household energy bills, that basically dropped out of the annual comparison, while electricity and gas prices fell by 7% in October this year. We also had food price inflation, less proportion of the basket, but still that slowed dramatically. And interestingly, producer prices suggest the level of consumer prices at the checkout could actually start falling over the next few months. Net result then, basically headline, that fell to 4.6, down from 6.7 in September. And I've just got in here as well, service inflation, again, a key measure for policymakers on the MPC, that fell to 6.6 from 6.9%, and well below really the MPC's forecast of 7%. Core, just to touch on that again, fell to 5.7 from 6.1. Obviously the high earlier in the year was at 7.1%. So encouraging, although probably should say unlikely to change that much again before year end. Of course, there has been substantial progress made with goods inflation, for example, but services inflation, again, that remains sticky, contributing around 3 percentage points to CPI, so about 2/3 of headline inflation. And the Bank of England actually has said they expect services inflation to remain robust for some time. And really, then we have to see a turn in that, a key turn in that, before rates can, of course, be cut or get anywhere near that. It's all around wage growth, that enduring strength in wage growth, which really adds to the uncertainty regarding services inflation. We did have those figures the day before, UK CPI actually last week, total wages, ex bonuses, well, including bonuses, actually, that's the key number. Pay growth slowed to 7.9% from 8.2. Private sector wage growth, that fell to 7.8 from 8.1. So falling at least, but still a very high and elevated. And even though some economists think it should sort of get into the 60s, 6.6% by March next year, that's still pretty elevated, and a worry for policymakers and this services inflation component, if you like. Also, the labour market data, that really didn't show that many signs of loosening. Payrolls rose 33,000 and unemployment was actually unchanged at 4%. So overall, probably higher for longer stance for rates. UK rates probably boosted by some of that data, even though, of course, it was encouraging that the trend is for lower prices. That may not change, as I've said, that much going into year end, at least. We also had UK retail sales that fell last month, 0.3%. Expectations of 0.4% gain. Some October softness, probably weather related, but the weak tone of sales generally kind of reflecting constrained consumers and soft growth trends amid, of course, still elevated interest rates. Okay, we will show you just this chart as well. This just shows you just how sticky UK CPI is compared to some of its peers. So you've got US in the red line, and you've got then other Eurozone countries. France just a tick below, actually, UK CPI 4.5% against 4.6%. But just showing you really how it is slightly more elevated than many other major economies. Okay, we'll just get on to UK flash PMIs. Actually, we do get those out this week, Thursday, tomorrow. Forecast number expected to tick a touch higher, 49.7 from 49.5. Manufacturing is expected at 45 against 44.8, and then the composite previously 48.7. The latter really fell. That fell below the neutral mark of 50 in September, the first time since January, and has remained there in October. Slowdown mainly attributed to the services sector. Obviously, that's coming down, but manufacturing, of course, that's been consistently below 50 since August last year, actually. Threat really of sustained inflation does remain slightly, as I've said, stickiness in that, and then this higher for longer theme in the UK potentially could help sterling as well. Otherwise, in the UK, we do get, of course, the budget out within the next hour, half hour or so. And just before we get to that, I just want to show you a cable chart, first of all, which let me just pull up that. But yes, the budget won't really be that market moving. It has to be said. If you just think back a year ago, actually, it's interesting. Obviously, we had that budget by Prime Minister Liz Truss, which really blew up the gilt market with her plans for unfunded tax cuts. This time around, Chancellor Jeremy Hunt, he's probably much more fiscally responsible. He is looking to deliver some tax cuts by all accounts, but those cuts really will not derail plans to stabilise the UK debt trajectory over the next 5 years or so. Possibly some looser fiscal policy will be welcomed by sterling, but at the moment you can just see a pretty narrow range at the moment. We're just sort of consolidating those recent highs. That recent high from yesterday, 125.59. You can see then the breakout of that descending channel. Big move started November, and then of course on UK CPI last week, that big move up and above the 200-day moving average, which is at 124.50. Then again, you've got these fib levels through 124.59. That's a 38.2 of this decline, and then the halfway point is at 125.89. So that would be an upside target for bulls before then 127. Otherwise, there should be some decent support around sort of 124.50, as I've said, 124.59. Okay, that's cable. Finally, we'll just touch upon Eurozone PMIs as well. They come out Thursday, expected to remain in contractionary territory. Manufacturing, slight tick up, 43.5 from 43.1. Services seen at 48.0 from 47.8, and then composite at 46.7 from 46.5. Basically, economists say forward-looking indicators like the ZEW surveys for Germany and the Eurozone have offered a small glimmer of hope, potentially that the economic situation in the zone will start improving over the coming months, but really a solid recovery is unlikely to take place until really Germany starts to regain some decent momentum. Aside from the metrics, participants will also be checking out commentary on inflation and growth developments within the survey period amid really deflationary themes that we've seen across major economies, including, of course, the US and the UK. Current market pricing for the ECB see the first full 25 basis point cut around June of next year. April, there's around 20 basis points plus of easing, interestingly. So potentially, if these numbers are worse than expected, those numbers will increase and possibly hurt the euro. Money markets see around 100 basis points of rate cuts by December next year. If we're just looking at, just bear with me, we'll just touch upon the euro, of course, as well here. Similar chart in a way to cable. Yeah, breakout of this descending bear channel, just oscillating around sort of 106. Kept that, and then this big move through the 200-day moving average. That's at 108.07 on euro dollar. Nice break up there, then a bull flag really, and another break higher towards them 109.59, and we did get above that yesterday, 109.65, but then pull back. So interesting whether we do keep a sort of halfway point 108.62 of this descending or of the summer sell-off. Sorry, 108.62 is the halfway point of that, and you can see we oscillated around there, so should see some support if we do drop lower. Otherwise, as I've said, top side 109.59 around that level to push towards 110. Okay, we'll wrap it up there. Actually, it's been short and sweet, hopefully for you guys. I don't see any questions at present. Just before I go, actually, yeah, just a chart on those Eurozone PMIs. You can see just the composite number below 50, which denotes boom bust sort of territory, and then Eurozone growth looking subdued, but some small glimmers of hope in some of those forward-looking indicators, as I said. Yeah, no questions. So great to have you on the call. Hopefully you will be with us same time in a couple of weeks' time. Okay, take care out there, and just watch out for the thin liquidity around Thanksgiving, of course. Okay, all the best, and speak to you soon.